So basically, as a result, then you have all these kind of opportunities for the social trading platforms to profit and kind of increase their spreads accordingly, kind of having a little bit of a monopoly, so to speak, for those platforms where people want to not just trade, because there's millions of different brokers out there, but also have the ability to have access to client capital without the regulatory frameworks. So you can actually find some of the especially the major FX pairs, they can have quite a wide spread, and obviously that cost is going to be passed on to the individual investors who have placed their capital with the money manager. As it's only spread based costs, it's going to come out of them their trading accounts accordingly. Another thing to notice that kind of looking at things in different ways is professionals do not use them. Now there's a reason why. If it was the be all and end all to use these social trading platforms, you would see the likes of the large hedge funds, etc., having a little dabble in there to try and get additional capital, but they don't. And the reason they don't is because of the lack of kind of really, in terms of what they're doing, it's a lack of opportunity. And that's even for the people who might manage, like ourselves, who kind of manage client funds but are not interested in this. We don't want to have tiny piddly amounts and trade copiers and all this sorts of little nitty gritty sort of stuff where you're not actually building a relationship with the clients. You want to have that ability to have quite good communication and a good rapport with your clients, and you don't want them to be just a statistic and kind of you're just one of a number as well of different traders. And it's all about what we'll come on to later, where you're kind of all tarnished with the same brush and you don't have a chance to really shine and stand out in terms of your ability. As we said here, we don't have a relationship with the people that are providing the services to you. So if you do well, you're kind of, oh right, okay, you're just a profile, there's nothing else there. If you do badly, it's kind of one of those things where you're just tarnished with the same brush. Everyone, it's almost expected that the majority are going to lose money over the long term. And yeah, so that kind of really does just suck in those people who want trade copy, a copy and framework, who really don't understand who are going to be targeting these social trading platforms. No accountability. So those people who are losing money, they're not being held accountable. As you said, they're just a profile, just a picture and a name. No one can validate the comments that are being made per se. You will get some active communication, but you get a lot of spoofing as well. So you get a lot of people that are just kind of trying to spoof other people, which doesn't really make sense because they don't have the ability to move the market anyway. Either that, or they are literally the best ever people to the best ever indicator to trade against and to make money. So it's all about kind of trying to identify how you're going to profit. So in my view, if you were going to look to make money, from your own account and you're looking for an indicator, look at a social trading platform and see what the kind of consensus is. If the consensus is in one direction, trade against it, because the vast majority of these accounts are amateurs, and rightly so. People have got to start somewhere, and that's not people are obviously going to try and learn from others who are going to be willing to actually divulge information and share ideas. But sometimes it is best to really think and take time to think about who you're going to be learning from. Are they experienced professionals, or are they going to be people who are also in the same position? During the start of my career, I worked in a professional setting. My career started in a proprietary trading firm, so that kind of helped me learn professionally. Learn what the professionals do to actually make money, as opposed to just looking online at some of the forums, etc. Now there are people who have done that and they do very well, but you get those extra added tips and a better way of learning if you do it on a kind of professional setting. And also, I was still there reading all the books, kind of continuing to learn, watch YouTube videos. YouTube videos do help. I wouldn't just use them solely, because a lot of people on there are actually piping themselves up. They want to get the views, etc. They want to kind of sell a product, and they promise these 100% returns in a week, so to speak, and that's not really consistent or sustainable, so to speak, over the longer term. They tend to always say how much they make in a week. Why don't they extrapolate it up to how much they make in a year? There's often a reason why. So you kind of got to make sure you think about who you're actually training with. Okay. So the conclusions we have from this video is that obviously there's no doubt that social trading has become increasingly popular. Same as the reason why people have flocked to trading their own capital on online brokerages. It's the same reason why this adaptation to provide a different service in a social trading framework has come about. Now, we've kind of outlined in the pros and cons here. In my personal opinion, I'm no doubt there's going to be many, many more, and you can I respectively respect your opinion. If you disagree with any of my comments, that's not it's not for me to profess to be an expert. It's just my views and what I think is kind of something that's not really sustainable. Lower spreads compared to previous decades. So, the reason we've had such a large boom, you've got the efficiency and the higher volumes in markets from online trading, that the way these companies are spending their money. They're spending on software as opposed to staff, really. I mean, you don't really need the massive commercial premises to house staff. It's more you need the commercial space to host servers, and then a smaller space in a central business district to have that presence, so to speak. So there are some cost savings from going online, but also there's some some increased costs of actually managing the online, so to speak, as well. So it's all about that shift, which is obviously making it more, giving us cost advantages as clients of theirs in terms of lower spreads. So as you see here, the technological advancements, computers are cheaper, you've got super fast internet connections now, there's fiber optic, etc., Wi-Fi, all these sorts of things that can aid anyone that wants to get in the markets, and it provides a bit more of a level playing field. People seem to think that banks and hedge funds have superior knowledge. Well, that's actually not the case. It's just that they know how to decipher it, and they've honed in on skills throughout their career to decipher the correct information and where they want to position themselves correctly, rather than kind of a scattergun approach. And that's basically what we do as Sanctuary. Is we want to build a rapport with our clients. We want to be able to have have a good relationship and over a long sustained period of time with our clients. We're not looking for clients that are wanting to double their money overnight or anything like that. That's not our style. Our style is consistent and steady growth, and you don't have that with these social trading platforms. So really, in order for you to be diversified on a social trading platform, you really need to be maximizing the number of accounts at which you spread your capital. And even then that might not be enough. You might just have the luck of the draw, and so to speak. Past performance is not indicative of future performance, of course, and do look for those longer longer time frames of history of results, so to speak. But even then, you kind of just got to look at their leverage, if it's available, and what they're doing. Ask them if there's your message, how much of you are you managing yourself, because that can really distort what your P&L is going to look like in terms of percentages. I mean, it's far easier to make 50% on £100 than it is to make 50% on £100,000, so to speak. And that's why the big firms, for example, the big asset managers, the hedge funds, they have so much money to work that they can't make those returns as highly as people think. Now, they make more money because they have more money in absolute terms that they manage, but in terms of percentage increases, they tend to kind of underperform the market, so to speak, in certain situations. So that's basically my thing on that there. So as I said here, even if you diversify, the percentages are against you based upon the number of people that are within the market. Now here's a cool final note that I want to talk about. And it basically represents a lemon and plum market. Now, those of you who are familiar with economics will get this straight away, and it's a bit of a, right, okay, moment. But basically, a lemon and plum market relates to cars. And what it means is, if you've got a high probability now in these social trading platforms of low quality traders, and say you have them mixed in with high quality traders, then they're all going to be tarnished with the same brush, because people are going to remember the bad traders. And if they based on the percentages, 95%, obviously across a large sample, you would suspect are going to lose money, then these people who are going to make money are not going to want to be seen in the same realm as those who lose money. Now, there are kind of contradictions to this, in the sense that people want to be seen in terms of, they do better performing, but as a whole, if people are going to see social trading platforms as a bad thing, they don't want to be involved, because they're going to be tarnished, and they're likely to pull out and go and set up on their own, or go to a more professional setting where they can manage money under a better framework. So what that means is that if all the good traders leave, and bear in mind we've just stipulated that the professionals are already out of this, they didn't even get involved in it, they're not there. That means the intermediates, becoming advanced traders who are getting their foot on the rung, so to speak, in terms of managing client money, they're going to look to pull out the market as well, because they don't want to be tarnished. So eventually means that over the longer term, you're going to have a market that's full of lemons. You've got a full of people who don't make money. So that's going to distort, again, the diversification aspect, where the percentages are against you. Regardless of the spreads, regardless of the advancements that we've had, if the percentage is against you, you're going to struggle. And we're not talking about minor little things here where you might lose 5% or anything like that. We are talking about, complete annihilation and kind of breaking down of accounts there. We're talking about doubling your accounts, tripling your accounts, and then the following day them being bust, so to speak. And it's far easier to lose money than to make money. So that's an important thing to note. So over the long term, my views are that the market is going to be heavily saturated, if it isn't already, based on the view that a lot of professionals are not going to be involved in the first place, are going to be full of people who do not make money. And the views that are going to be switching around means that people are not sharing valuable information, and not sharing information that is useful necessarily. And people aren't learning or anything like that. You've got this kind of bubble of people where they do not make money, and people who are unsuspecting investors are going to be kind of brought in, not really understanding the full works behind the scenes there. So that's basically my view there on social trading platforms. I have written a blog post on here, so please do visit our blog at www.sanctuary.co.uk/blog. Now, there are a number of different blog posts on there. There's a welcome one for me, just about how I started the business and how we're growing, etc. There's another one on that I wrote earlier today about the Great British Pound falling to new lows, 31-year lows, and I'm going to be updating this quite regularly now going forward, as kind of the daily doses are great for us to actually learn and understand what's happening in the market, but for certain situations there's sometimes not enough time in the market, in the video to actually explain thoroughly, based on the fact that you do want something a bit snappy and kind of like a 5-10 minute quick daily video, as opposed to an hour long stretch of analysis, which can be great, but can also be disengaging, so to speak, as well. So please do have the opportunity to have a look at our blog post there at sanctuary.co.uk. There is a link in the description below. Don't forget to like and subscribe if you like the content. Join in with our daily doses, and if you have any queries, please don't hesitate to either leave a comment below or visit our website. Make sure you sign up to our blog, and there's also a contact us page where we'll be able to kind of relay any information that you require, either about our videos or anything in general, our products and the services that we provide, anything like that. So thank you very much for taking the time to watch this presentation, and good luck in the markets, and see you soon. Thank you.